Is the housing sector in the UK a ticking bomb? What is the scenario with the UK's economy? Due to rising mortgage rates and steadily declining home prices, the UK housing sector has recently been in crisis. The housing market as a whole, as well as owners, purchasers, and renters, could be affected by the crisis. Let's dig deep into the UK's mortgage crisis. These new shifts builds on a very distinct patterns of house price increase that existed over the prior 15 years. Prices in Northern Ireland have not yet returned to what they were before the 2008 global financial crisis. Price increase, however, were not swift in London and the South East, lasting until 2015. After the outbreak, when many individuals relocated to less expensive locations and searched for more rooms, their population grew more slowly. Rising interest rates increased the cost of new mortgages. Asking prices haven't fallen by a sufficient amount to make up for this. It is therefore doubtful that purchasing a property will become more inexpensive for the first-time buyers shortly. If salaries grow more quickly than home prices do over time, housing will eventually become more affordable. These long-term development also depends on how well the housing market performs. In June, the UK's housing market had its fastest annual decline in 12 years as pressure from steadily rising mortgage rates increased. According to Halifax's most recent price index, real estate prices fell 2.6% in the year to June, the most since June 2011, and a substantial increase from the 1.1% annual fall seen in May. For the third consecutive month, prices decreased, falling 0.1% since May. The average price of a home in the UK has dropped from peak of €293,992 in August 2022 to €285,932, $364,490, following the catastrophic fallout from the UK's mini-budget in October, which saw mortgage rates soar and house values collapse. Tim Kinnard, director of Halifax Mortgages, said the annual decline masks a tiny recovery in the price this year. Average house prices are up by 1.5%, roughly €4,000, so far this year, with most of that growth coming from the first quarter, following the sharp fall in prices we saw at the end of the last year, she claimed. On the other hand, she continued, the housing market remains sensitive to volatility in borrowing costs. Over the past year, rising borrowing prices have plagued homeowners and prospective buyers as the Bank of England has attempted to control inflation that remained persistently high. In June, the BOE increased interest rates for the 13th time in a row, this time by an unexpected 50 basis points, bringing the base rate to 5%. In May, UK core inflation increased month over month. High levels of inflation and higher benchmark bank rates have increased UK sovereign gilt yields, which are used to calculate mortgage rates. As a result, some lenders have raised rates or discontinued specific products. The most recent rate increase was not completely reflected in the Friday's housing data, according to Sarah Coles, head of personal finance at Hargreaves Lansdowne, which likely means further hardship for borrowers. According to Moneyfacts, 2-year fixed rate began June at just under 5.5% and 5 years terms at 5.1%. And they concluded the month at 6.4% and just shy of 6% respectively. When new rates are reflected on the data, all eyes will be on the potential damage, Cole said CNBC. She said that as the price continued to decline this summer, higher mortgage rates appear destined to exert additional negative pressure on the housing market. To move their properties, sellers have already begun to lower their prices. According to Zoopla data, 1 in 20 people cut their hair in May. With a 9% average, price reduction will probably spread much more during the summer, and house prices could drop even further, she warned. According to Knight Frank's head of the world's research, Liam Bailey, the domestic property market has further to fall in terms of pricing. The real estate company reported that a first quarter saw a 3.1% yearly decline in UK houses prices in its most recent global housing index, which was issued on Wednesday. First-time buyers will appreciate cheaper costs, but higher rates imply affordability will remain a challenge for the majority of new market entrants, he said. The Bank of England is anticipated to continue its tenacious effort to control inflation by raising interest rates through the remainder of the year. Market observers currently anticipate rates to peak between 5.75% to 6% in November. However, JP Morgan warned on Thursday that rates under some scenarios may reach 7%, according to Matthew Ryan, head of the market strategy and multinational financial services company Ebury. Markets have continued to ramp up bets in favor of higher Bank of England interest rates in the past few days. Swap rates now see terminal BOE base rate of 6.5% by mid-2024, a total of 150 additional basis points of hikes. As a result, mortgage rates are expected to increase before decreasing, which would hurt homeowners and exacerbate the UK's escalating rental prices, as buy-to-let landlords either pass or increase mortgage repayments to renters or leave the rental market altogether. The assumption is that mortgage rates will remain higher for longer, and the pressure on household budgets will continue to put downwards pressure on house prices over the next years, according to Halifax Kinnard. Markets now forecast a peak in bank rates of over 6%, he added. The carnage in the mortgage industry is impending forecasts of a significant increase in borrowing costs have prompted analysts to predict that house values may decline as much as 20% as a result of the unrest in UK financial markets. The housing market has been defying the doomsayers for months despite the tightening cost of living pressure. The upheaval caused by Kwasi Kwarteng's mini-budget may finally be poised to change that. A decline of perhaps around 10% is what senior mortgage technical manager Ray Broger of home loan broker John Charcoal forecasted for the coming year. According to analysts at companies like Credit Suisse, it may be between 10% and 15%. Some people asserted that it might even be worse than that. What could be worse than 20% drop in housing prices? How about they don't crash by 20%? With increased borrowing prices, inflation, and decade of more restrictive mortgage lending, the UK real estate market confronts the possibility of freezing solid rather than declining, and that could be the worst of all worlds, claims a recent Joseph Rowntree Foundation analyst. In this case, low unemployment causes very poor sales, which results in little change in prices but stagnant transactions, a halt in the construction for new homes, and cash-rich investors swooping in to outbid individuals with lower incomes. The end effect is similar to what we have today, but worse. Rents spiral upward, while homeowners remains out of reach for all, except the wealthiest people. This situation could endure for years, and no one gets to take advantage of the lower cost when the cycle resets. But is that worse than a collision? A woman who worked for Citizens advised 30 years prior said that when she considered the people affected by the early 1990s recession, which saw a 36% decline in housing prices in the southeast and a 20% decline nationwide, she still got choked up. The worst were those who came to visit her with bundles of unopened bills in an attempt to hide how awful things were from her relatives. Toby Lloyd, a co-author of the report, says, "We have a kind of folk memory of the house price crash of the early 1990s. We haven't realized how much has changed since then though. Homeowners today are significantly less vulnerable to price declines than they were in the early 1990s or even in 2008. According to the English House Survey, the majority of homeowners in England have not had a mortgage for the past 10 years. The most eye-catching policy suggestion in the paper includes giving council specific authority to restrict who can buy in the region. This would prevent large home builders from stuttering projects until market conditions improved and would stop investors and corporate landlords from scooping up houses. The average price would only return to where it was at the beginning of the pandemic if UK property prices dropped 20% from their peak last year." Neil Hudson, another report co-author, said, "There will be people who suffer from negative equity, but they will be, thankfully, relatively few in numbers and help can be provided. Stability is the main concern." How likely is a freeze of this kind in the market? Right now, it appears that things are chilly. Sales in January were down 11% from the same month last year, per data from HM Revenue and Customs released this week. Many of the transactions happened before mortgage rates started to soar. According to Rick's monthly market report, buyer inquiries, agreed deals, and new directions are all decreasing. That's it, guys. What do you think of the mortgage problem in the UK and what may be the solution according to you? Let us know in the comment section below. For more videos like this, subscribe to this channel. Thank you for watching.